I'm Anthony Smith, and you're watching the Chart of the Week. Hello, and welcome to our weekly video. The Fed announced on Wednesday this week that it raised its overnight target rate by a whole 25 basis points to now be in the range of a quarter percentage point to a half a percentage point. And that is the chart you're looking at here. This is the Fed funds target rate going back to 1980. And if you're having trouble seeing the increase this week, let me help you out. Oh, there it is. It's a blip on the radar. So this is the first rate increase since 2018. And not only that, but Fed officials indicated they expect to raise the target rate 6 more times this year to about 2% by year end. That is the announcement. I'd like to provide a little of my perspective on these matters. The Fed has 2 mandates: full employment and price stability. On the first matter, the U.S. labor market is very strong right now. Unemployment rates are back down to pre-COVID levels. Ask any business owner what it's like to find labor these days. It is very difficult. All right, on the second matter, price stability. Prices are not stable. Inflation is the highest it's been in 40 years, and it really deserves the attention of the Fed right now. February CPI showed inflation at 7.9%. Perhaps even worse than inflation being high is that inflation expectations are high also. And you may have heard at some point that inflation expectations are like genies in bottles. And now I don't have any firsthand experience putting genies back in bottles. I know enough to know that it is darn near impossible. Inflation expectations are similar and are very dangerous. Historically, when inflation is running persistently hot, the Fed has had to raise rates very sharply to fight inflation. And I hope I'm wrong, but I don't think a series of quarter percentage point hikes to get to an overnight rate of 2% by year end is really going to have the desired impact of achieving price stability. What I've heard and read a lot is that historically, when inflation is hot, the overnight rate has to be higher than the rate of inflation in order to really get prices under control. If that's true, the Fed really needs to hike faster than it is right now. Inflation is at 7.9%, like I said, and we're expecting the Fed funds rate to be 2% 9 months from now. That is a substantial gap. So Fed announcements can be considered hawkish or dovish, and allow me to illustrate or define those terms really quickly here. A Fed announcement is considered dovish when the Fed is loosening policy, lowering interest rates in an effort to support economic growth and inflation. The Fed is considered hawkish when it is doing the opposite, when it is tightening monetary policy, increasing rates in order to keep the economy and inflation from running too hot. This Wednesday's announcement was considered hawkish, and it's mostly because of its guidance to increase the Fed funds target rate at each of its next 6 meetings through to year end. And because this has been repeated enough that it's been a hawkish meeting, I guess we're all supposed to accept that it was a hawkish meeting. Well, I don't accept that this was a hawkish meeting. I think we'll see a hawkish Fed and hawkish meetings in the future if inflation stays hot. If inflation comes back down to 2 to 4%, then we won't have to endure a truly hawkish Fed. But I do think at this rate that we're going to see a very hawkish Fed at some point. Where's the good news in all of this? And I think the good news is that investors who are invested in equities, if history is any guide, investing in equities, and in particular value stocks as opposed to growth stocks, is a good way to protect wealth, to grow wealth at a rate that outpaces inflation. If you have any questions about that, please give me a call. Otherwise, thanks for watching. We'll see you next week.